Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to discuss with you a subtle distinction that is nevertheless fairly important when doing international tax planning, international tax optimization. And this is the distinction between permanent establishment and source of income. Okay, so this is there's some overlap, and these concepts seem to get a little bit convoluted. I've noticed there are some people out there giving advice where the advice is kind of bad, and it's partially based on not really understanding this distinction and kind of honing in on something that doesn't necessarily apply in certain cases, and then ignoring something else that may apply. So we're going to talk about it today. If you're interested at all in how to optimize your international tax, it's a really important subject. It's kind of one of the three key pillars that I discuss. And so, yeah, let's dive in. Before we do, if you haven't already, please hit the subscribe button, hit the all notification bell. Really appreciate your support. Share it with your friends. Please help us grow the channel if you like the content. If you don't like it, hey, well, tell me why. I appreciate the feedback. Now, what we want to do here is we want to make a distinction between what is the application of permanent establishment rules and source income rules. So just a really quick recap for you. You are taxable based on three factors, okay? Where the legal person is based, often this is a company, and for the purposes of this, we're talking about corporate structuring, so we're talking about companies, okay? So where a company is resident, there's taxability based on that. Where the shareholding is based, there's taxability on that. And where the income is resident, taxability based on that. So residency of the company, residency of the person, residency of the income. And people seem to confuse some of these, so I've created some other videos to try and explain and kind of demystify some of the common overlaps. For example, I was having a call with a client earlier today, and just the distinction between controlled foreign companies and foreign management is a common one that you run into. And this is a distinction between the residency of the company and the ownership of the company. Okay, two separate things. Both could apply. One could not apply, one could apply, etc. But we're going to focus today on the source of the income. What does this mean? This means that you could have a foreign company with a foreign owner, and if the income is locally sourced, or rather, if the income is locally resident, then that income will be taxable locally. Now, whether that income is locally resident or not depends on the particular rules in the case of the country and the relationships between the countries. So what I typically hear people say, they don't really understand the way that international tax works, etc., is they often hone in on this idea of permanent establishment. And they'll say, hey, you can't have a permanent establishment in that country, or you're in a situation where if you have a permanent establishment, you're taxable. And neither of these is necessarily correct, okay? So the way that this works is not all countries deem source income based on permanent establishments. Okay, that's point number one. Number two, not all countries have the same definitions based on the same types of income for residency of income or source of income. Okay, so let me give you a quick example of this. You may be in a situation where you don't have something that we would consider a permanent establishment under the terms of, say, a tax treaty in Hong Kong, but you may still be taxable in Hong Kong because Hong Kong has the operations test. Okay, that's one example. Another example is you may not have a permanent establishment in some place, but the nature of a transaction means that title changes in a particular place and that may trigger tax. You may be in a situation where you don't have a permanent establishment somewhere, but you're earning royalties income from that place, and that triggers tax. You may be in a situation where the type of income means that the customers have to withhold. For example, this is a common thing in China. Okay, so it varies country to country. You have to understand that for every country you're looking at, you need to understand how do they determine local source income. And this is complicated because of the fact that a bunch of countries, although they claim to tax local source income, they don't define local source income. So then you have to figure out, okay, well, what is the evidence that they use in order to judge what is local and what is not? The important thing here is permanent establishments are not necessarily the sole thing, and a lot of countries don't have permanent establishment rules in their local domestic legislation, okay? And so where permanent establishment rules mostly show up are in tax treaties. Now, the problem is most countries don't have tax treaties between one another, okay? What does this mean? This means that you might have, so let's use a simple example. Maybe I'm talking about between Canada and the US. Okay, there's a tax treaty between Canada and the US. In the terms of the tax treaty, what it says is if a company is resident of one state but not the other state, then they're only taxable in the other state to the extent that there is a permanent establishment there. In other words, if a company is resident in, let's say, Canada, then the only way it's taxable in the US is if there's a permanent establishment there. And this actually overrides the local domestic rules, okay? So actually the broad source income rules in the US, if there isn't a tax treaty, are quite broad. If you are in a case where you have a tax treaty, then it narrows it to being somewhat simpler, where you've got this permanent establishment. Okay, so that kind of approach. And I'm oversimplifying this for you. Don't take this and run with it and say, okay, this is what Michael said in this video, because this is an oversimplification. I'm trying to just kind of boil it down so you get the sense for how this works. Now, if you understand that a permanent establishment is not the sole way that you can have taxability, then you can understand that the US only has about 50 tax treaties. And so if you're dealing with a country, let's say, for example, say a Hong Kong company is dealing with the US, then you may be taxable on other bases aside from simply the permanent establishment. Okay, so that's point number one. Number two is you may be in a situation where you're dealing with a country that doesn't have local permanent establishment rules, okay? And so you actually have what, for the purposes of a tax treaty, may be constituting a permanent establishment, but that doesn't trigger local rules. And so you don't get taxed regardless. So this is a really important thing to bear in mind. The point that you want to pay most attention to is how is what I would call the residency of the income, or the source of the income, defined for the country that you're dealing with, given the relationship to the foreign country that it is dealing with. So that's very specific from country to country, and even from tax treaty to tax treaty, if there is a tax treaty. In many, many cases there are not. So I hope that helps. I hope it gives a little bit of an idea. It's just something that you need to be aware of if you're looking at these things. And I've just seen a lot of information on the internet and people putting out different comments where they're very fixated on this thing about permanent establishments, and they do it at the exclusion of something else, and maybe in cases where permanent establishment rules don't exist. And then on top of that, they often don't accurately look at how the tax treaty defines a permanent establishment, and how therefore something that is present there may not even constitute a permanent establishment of the tax treaty. So there's a lot of, you get some people who it just ends up being inaccurate advice, and so you need to be a little bit careful. So I hope it helps. If you have any questions, reach out to me. You can book a call, www.calendly.com/Michael-Rosmer, link in the description below, or put a comment below and we can address it there. I will look forward to seeing you very soon.